Okay, everyone, are we going? Welcome. Okay, hopefully you can hear my voice, see my face, and see the screen I'm sharing momentarily once I start sharing it. All right. Welcome, everyone, to a market update for April 23rd. My name is Gordon Scott. I'm here sharing the Actions 12 market update for the US stocks and what that might mean for several currencies. So I hope that you'll find some interesting stuff today. I think you will. Let me draw your attention to the chart that I'm sharing first. This is the S&P 500 US stock market index. And what we're looking at is a 200-day moving average with one ATR, one average true range up, and one average true range down. And that should be what you're seeing right now. Let's make sure that that's actually the case. Okay, well, I'm just going to have to go with it here. This little bit right here, these blue lines, these represent one ATR above and one ATR below. The line in the middle, that's the 200-day moving average for the S&P 500. So what the significance of that line is that if stocks are above that line, most professional money managers in the US will consider that the S&P 500, that stocks are generally trending upward. And you can see that. You can see that in the same sort of pattern that is in the candles here. It's going up, it's going down, up, down. But as it's going up, it's making higher highs and higher lows. So we have a very clear upward trend, right? And now where we are, we're kind of right at the same place where the old high was, but we haven't broken through and made a new high. And this has got some folks a little nervous. There are a couple of other signs that have got people nervous in terms of, stock market forecasters that think we might be in a situation where we're going to turn around and go downward. And I'll show you what those indications are and why people are worried. But I also want to kind of point out that probably that's not going to happen. Probably we are going to break through eventually and make a new high, and then a new higher low, and continue trending on at least for the next 2 or 3 months and through the next quarter. I could be wrong about that, but I'll share my beliefs with you about why I don't believe that that's wrong, or why I believe that I'm not wrong. So first off, let's look at this chart that I think a lot of people are very concerned about. This is a squiggly line chart which shows all of the different sectors of the US stocks. And it's important to sort of recognize what's going on. This is, the index is 500 stocks. And of course, there's thousands of US stocks, but they're sort of divided into certain industry sectors. This is going to be energy and basic materials and finance and communications and the big market sectors, right? Well, you can kind of tell what's going to happen next with the market if you know how to read those sectors. Certain sectors are ones that people think of as big growth stocks, stuff like technology or communications. Those are the kinds of things that people invest their money in because they they feel like those stocks are going to grow a lot. And that's companies like Apple and Microsoft and you know, the household names that you think of when you think of technology. Um, but then there's another set of sectors, which are what they call defensive sectors. These are sectors that just kind of keep going up. The stocks in them just keep kind of going up slowly. Companies like Coca-Cola or McDonald's or Starbucks, right? They might fall in those. That sector is called consumer staples. And consumer staple stocks don't tend to go too fast. They just tend to go up when people want a safe investment. They pay nice dividends. And so people tend to like to buy and hold on to them for a long time. But you can kind of tell that the people are worried about the market if those are the leading sectors. Those are the stocks that are leading all the rest of the market. Another sector that's that way is the utility sector. Now, this is the electricity companies, the natural gas companies, and the water companies. These are the companies that have kind of a monopoly in their own little area because they provide electricity, water, or other things to a county or a state or whatever, right? And so these companies, their stocks hardly move at all by comparison because they usually pay out a lot of dividends. And so they have low volatility and they also pay dividends. It's a great way to make a safe investment. It's not going to double or triple within a year, but it is going to return a very nice, predictable investment. So when people think the market's going down, especially professional investors, they'll start putting their money into utility companies. And the last one that's kind of a defensive area is healthcare stocks. Healthcare stocks tend to be the things people invest in because, well, everybody has them. In a recession, you're not going to stop taking medicine or something, right? So those three, they tend to be the sectors that lead if the market is full of nervous participants. And the biggest indication of when a market is ready to turn down is usually that everybody in the market is very nervous. Well, if I look at this sector or these sets of lines, I can see an important pattern emerging here. If I look at this top line, it's XLV. That's the healthcare sector. How about this one? What's the second one? It's the financial sector, banking. So that's interesting that banking's at the top, right? And then how about this third one? It's energy. Now, if I shift this forward so that I start after April 1st, look how it changes. Here up top, I still have at the top healthcare, but now I have this red one, which is utilities, and this purple one, the financial. Then down here, I have consumer staples. So the financial, everybody thought that the US bank financial sector was going to have real problems because of a recent bank failure that happened with Silicon Valley Bank. But it seems that that's going to be pretty contained. There's not going to be a big worry there. And so people are putting their money back into financial sector. That's why it's up top. But the other one, besides that one, are those three, are the defensive sectors. Now, it's only been since the beginning of the quarter. If you go back before the beginning of the quarter, they're not the top three. But just since the beginning of the quarter, they are, which means that right now, people are very nervous. Now, there is one important thing that will overcome nervousness, and that is good earnings. If companies come out and say, yeah, we earned a ton of money, much more than we expected, that will make people less nervous. They'll start investing in these other companies. But for right now, they're nervous. And this is a sign that oftentimes will precede a bear market. Another sign that precedes a bear market is that real estate starts having trouble. However, that sign has not really appeared yet, not in a big way. Yeah, housing prices have slowed down and so forth in the US. But this industry group right here is the retail home builders or residential construction. These are companies that actually build homes on large scales. And people have been expecting this sector to keep going down because interest rates have gone up, making it harder to get loans, making it more expensive to buy houses, and yet it's not happening. These things still keep moving higher. In fact, one stock within that industry group is DR Horton, and it is the biggest builder in the US. And it just released its earnings report on Thursday, and it was a big surprise. It was 23%. They came in 23% ahead of estimates for sales and 40% ahead of estimates for their earnings, for their profit margins. So that means not only did they make a lot more money than everybody expected, they're doing a better job of managing their expenses and making more profits or increasing their profit margin. So that means that their companies are healthy and they're not in danger. It was a big shock to everybody. That's why the prices jumped way up the way they did for that company. Well, if in fact we're going to have a bear market, we should expect to see those companies having a terrible time. This is a big reason why I think people are nervous, but I think that they're going to get over it. I think that companies are going to come out and say, actually, we're not doing so bad. We're earning money. Here's a one that is that did that kind of. Netflix. Netflix came out and they missed on their sales, but by just a tiny little bit. They were supposed to come in with 8.1 billion in sales, and that was their estimate. And they did. They came in with 8.1 billion in sales. They missed it by about 15 million. Tiny. It's less than 1/5 of 1%. But even though they missed by just a hair on their earnings, they actually increased by a hair on their profit margin. So they're learning how to run their business better. And Netflix is, if people were going to cut back on spending, that'd be an easy one to cut back on, right? And yet they're not. They're not doing that. So this could be an early indication that we're going to see a decent earnings season coming through here. And if in fact we manage to see a good earnings season, then we'll probably see the S&P 500 get up there and make a new high. There's Investopedia reported that the average office vacancy rates across the U.S. Rose, and which means that businesses aren't renting out as much as they used to. That means commercial real estate should start suffering. And maybe this is the answer. Maybe this is why home builders are actually doing well, because people are moving out of commercial offices and working from home. Not entirely, but more than they did before the pandemic. Many companies are pulling people back into the office because they actually want them to work at their job, not work at some side hustle or something. But all that's going to regulate, because in many cases it's cheaper to have people work from home, so long as they're actually doing a good job. So all of that is shuffling back and forth. But I think that even though there are these scary indications, that generally speaking, we're still on track for the potential for things to go well. The first indication that or I should say, the next indication that we're going to get is probably going to be from companies like Amazon, which is going to release earnings in the upcoming week. Thursday. And that will probably, it's trending higher. It's finally made its way above its 200 period moving average. And just here recently, just on Friday, look at that volume, a big volume of buyers and a gap higher, and that's earnings coming up. So they're expected to earn or to make 124 billion in sales. That's compared to 145 billion in sales last quarter. Well, last quarter was like the Christmas quarter, and so that's the fourth quarter of the year. They always do really well. So the fact that they're coming down from that is not a bad thing. It's not a big surprise, but it does show you that, hey, it's not going to be all that hard for them to hit this new number, this new estimate. So if in fact they do, everything should be great. We'll keep continuing on, right? So I think that's the one to watch in the coming week. And then last of all, I want to show you this index, the US dollar index. US dollar had been strengthening for a long time, but then here, just since November, it's made a major turn. And with the US dollar going down, that means a lot of dollar denominated pairs in the currencies are heading up. And is that likely to continue, or are we going to see some amount of dollar strength? My guess would be that it's going to keep going down. What started it going down was the realization that the Fed might not continue raising interest rates. A couple of weeks ago, we had the CPI reports, which said that inflation numbers, consumer price index numbers in the US went up by only 0.1 over the last month. 0.1. If that same rate were to hold out for the next 12 months, then the US would only have a 1.2% interest rate. I mean, that's crazy. It's not likely that inflation has gone, or inflation rate is not likely that inflation has dropped to that. However, it's also not likely that it's going to continue to push up around 8% over the next year. And investors have reflected that over the past several months by pricing in a change of rising interest rates to a change of falling interest rates. I don't know how long it'll take before the Fed says, okay, now we're done. And then they decide to start cutting interest rates to some degree. Don't know how long it'll happen. I do think that the Fed will stop raising interest rates sometime during the summer. And I think that's what the market expects too. In fact, they're already kind of equilibrium sitting down here at this base on the US dollar in anticipation of that. So should anything change, that's going to change the way the dollar starts working. And so we look at the currency pairs, and what we see is that the euro, well, let me just zoom in. The euro is doing the opposite. Dollar's coming down, so naturally the euro's going up. And it's kind of flattened out here. This is a 4-hour chart instead of a daily chart. Kind of flattened out here towards the end of the week. So it's kind of waiting to see, what are going to be the reports out of the US in terms of earnings and various other things that are going to determine whether or not the Fed may kind of keep its interest rate hikes limited. Well, that's what we're looking for, to see evidence of that. And right now, the euro just keeps going higher and higher because they do expect that will happen. There we go. And the British pound, by contrast, I'm trying to zoom out of that. There we go. Although it has been going up against the dollar, it has started to sort of level out even at a more measured pace. So if in fact the dollar reverses and goes up, the pound is probably going to be the weak one, probably a good one to try to consider shorting. I mean, here on the 4-hour chart, we've got a sort of head and shoulders pattern. It's kind of a messy pattern, but we've got a lower high compared to what had been higher highs. We don't have a lower low yet, but that could come this week. were the pound to drop below 1.23546 or so, let's just call it 1.235 even. If it were to drop below that, that's probably an interesting short play, probably a good move that could run down to 122, 123 even. Yeah, probably down there, 123 even. So that's a nice, what is that, a 50 pip move that could probably happen within a day. And Aussie has been very flat, has had a hard time taking off. As the euro's been going up, the Aussie's just kind of been drifting. So same kind of situation. If somehow the dollar starts strengthening, the dollar will strengthen if in fact US stocks start looking unfavorable, because people will pull their money out of stocks and into dollars, right? They'll also, the US dollar will also strengthen if somehow the Fed says, you know what, we're going to keep raising rates. We thought we could stop, but we can't. We're just going to keep raising them. If somehow they keep sending out that message, then you're going to see the dollar kind of pull up off of its support, keep going higher, and all of these currencies are going to really take a dive at that point. And probably the Aussie yen, the Aussie, not the Aussie yen, Aussie dollar is going to have the roughest time of them if that happens. I don't expect that to happen. I expect the dollar to break through its support and weaken, which would mean that you would see the Australian dollar make new highs above 67.85. You'd see the pound head up above 1.2535. But more importantly, I think you'd see the euro get up over 110 and keep heading up, maybe even to 111, and trending higher. And I kind of expect to see that over the course of the next 2 or 3 months, because I expect US stocks to continue to go well, and in a corresponding fashion, US dollar to weaken as interest rate expectations sort of tamp down a bit. So with all of that in mind, what would be the best kind of currency trade that I could think of out there? And I think the answer in my mind is the euro. What kind of trade setups could I make for the euro? Well, I'm not a licensed financial advisor, so these are just educational ideas. The Actions to Wealth team's got some fantastic setups that can be seen by the Daily Wave Rider and others. I want to just make something real basic here, though, and that's this. You can look at this chart and see a simple channel being played out here. Something like that. And that. Make the sort of parallel lines. There we go. Hopefully I can make those thick enough for people to see. There we go. All right. This trend line, I think, is sort of the opportunity line. It's like the middle of the trend. And what this I feel is useful for is for us to sort of watch and say, okay, whichever side breaks out and the bar closes, there it is, first on that, or closes above this top line, there it is, above that top line or below the bottom line. Whichever happens first, that's going to signal the breakout of which trend, which way it's going. I have these ATR envelopes here, Keltner channel envelopes, and each one of them is one ATR. And you'll notice that these lines line up with one ATR above and below pretty nicely. So that tells you what's happening with the price is it's just moving with a normal degree of fluctuation. It's as much of an equilibrium as it could have. So whichever side it breaks, that's going to be a tip of the hand, a sort of showing of the cards by the institutional investors. And I think that's the way you could make a plan for a trade. And the way it would go would be that you could make a trade. I could set this trade up so that the stop would be the other side, 2 ATR lower, the other side of this channel that I've drawn. That's where my stop would be. And my target would be that same distance higher over, the course of maybe a couple of days. Now, if it reaches the target, I don't want to just immediately end. I just want to raise my stop up to the entry point and then just sort of let it trail from there. That's a good strategy that should allow you to capture any sort of long running trend once it gets going. I think that's probably the simplest, easiest, trend idea or trade idea I could make. Buy the euro when it breaks out of that channel. And here's a more sophisticated idea that actually has a very tiny trading edge associated with it. And that is to wait until it gets underneath this moving average and then buy down in here 1 ATR, sort of the lower half of that channel. You can look at that and say, well, that's just buying cheap. Why wouldn't anybody do that? Well, because it might not come back. It might just break out of the top and then keep going. And you'd miss the trade unless you were prepared and planning to do that. But if you're not the kind of person that likes to try and jump on the train as it's leaving the station, then you're the kind of person that wants to wait for a dip. And that the way to wait for that dip would be buying underneath that moving average, even while it's still turned up and trending higher. And that tends to be a good way to do it. It's not foolproof because price could just as easily go down, but it's a good place to make a sort of launching off trade. All right. Those are the main things I wanted to share. And I hope that's useful. I think that there's probably some interesting things that can be seen in some of the other areas. So before I leave, I want to quickly look at price of gold. Gold's got a stronger trend in the US market right now. It's been pulling back, but there's a good possibility that we could see that trend continue so long as the Fed thinks they need to keep raising interest rates. The market, the US market, as we discussed, is acting like the Fed, they're not really going to continue raising interest rates very much longer. But if we look at the price of gold, that's telling a different story. That's saying, oh yeah, they're going to have to keep raising it. Not very fast, but little by little. That's what this trend is saying. So either one of these two is wrong, or gold is about to change its trend from strongly up to something more sideways. There's actually quite a bit of volume. See these tall bars here? Quite a bit of volume in the selling side compared to where there had been all the way up. So it's very, very possible that gold has kind of hit a peak and that the better play is not to be a buyer right now. Wait until it pulls back substantially. Or if you have some way of doing it, to be a seller of gold, right? That is to say, like if you have the ability in your Forex account to trade the XAU USD cross, then it might be that shorting that thing could do well somewhere here in the next month or two. I would feel it's a little early to do that, but what would I be looking for? This right here. I would want to see the price break down below this old high and this region right here as depicted by this line. So if it came down and got underneath that line, I think then there's a good chance we could see it drop further all the way to its 200 period moving average. All right. That's what I have for you tonight. I hope that's useful, and I look forward. Oh, no, I apologize. There's one more idea I want to share with you, because I want to tell you uh, in the not too distant future, I'm going to be giving a presentation in the Actions Wealth community. And it's a really interesting presentation, one I haven't done before, but it's going to talk about how to find an edge, how to find your own edge in the market, in any market, for any person. What kind of edge? How do I recognize what an edge looks like, and where are the places that I should go looking for one? Do I have to do all this deep, font Python programming? No, you don't have to. Edges can be found readily all over the place. The most important question about a trading edge is, can you make it work? Is it right for you and for your circumstances? So I want to be telling people about that. Look for that presentation to be coming up sometime later in May. Until next time, everyone, take care and trade